This chart shows the trajectory of the wider semiconductor index. From late March up to early September, it traces out a massive 95% run-up. The entire sector was priced for absolute perfection. Then, right at the peak, Broadcom released its earnings report. They didn't actually deliver bad news or miss their targets. They delivered fine news. They hit their marks, but they failed to raise their future guidance. Broadcom is a keystone species in this ecosystem. They are the ones working directly with all the major players to build custom artificial intelligence chips. When market expectations are that high, fine is heavily penalized. In a single trading session, the stock took a brutal 12% hit. If the entire AI trade was a fragile bubble, losing a leading supplier in a violent sell-off should have been the pinprick that brought the whole thing down. But the panic never spread. The contagion simply didn't happen.
This visualization captures the disconnect. You have Broadcom taking that massive 12% drop, but right next to it, the broader index barely flinched, dipping only 1%. That level of resilience requires an explanation. It forces us to look past daily market psychology and examine the actual structural engine driving the AI trade. Big macroeconomic voices are looking at today's tech market and drawing direct comparisons to the late 1990s. There is genuine fear in the headlines right now, primarily driven by international tensions, like instability involving Iran and fluctuating oil prices. But history shows us a clear pattern from that late 90s era. You can have very real, very scary external threats, while the market underneath continues to climb. Take 1997. The Asian currency crisis hit hard. It was a severe macro shock, yet the S&P 500 finished that year up 31%. The following year brought the Russian bond default, another major scare, and the S&P still finished up 27%. The takeaway is clear. Broad headline fears cannot stop a market if there is a powerful, verifiable economic engine humming underneath all the noise. Today, we don't have to guess what that engine is. The AI trade is backed by actual ledger data. If you look closely at the balance sheets, you find mega-cap tech companies expanding their revenues at an 80% clip. This graphic breaks down the math. We have that massive 80% revenue growth, but it is matched against a 25 times price-to-earnings multiple. The valuation has not outpaced the actual cash coming in. That revenue is coming from one highly specific source: agentic AI tokens. A token is simply the basic unit of measurement for artificial intelligence. It tracks exactly how much real-world computational work these models are performing. This chart tracks the production of those tokens. From the formalization of agentic AI at the end of January to the end of March, the volume completely doubled, a two-fold increase in just 2 months. That explosion in actual usage is the structural firewall. It provides the concrete profits that kept a 12% drop in a major supplier from collapsing the entire sector. But passing one stress test does not mean the sector is invincible. There is a looming threat on the horizon, and it sits entirely on the cost side. Over the last year, companies engaged in what is called token maxing, intentionally overspending to ensure every employee was experimenting with these tools. That phase is ending. Executives are starting to look at these massive computing bills. So if budgets are tightening, how does the AI expansion continue without crumbling under its own weight? Capital does not just evaporate, it reroutes. Instead of cutting the AI budget, companies are draining legacy expenses to feed the new technology. The first things to go are expensive external consultants, traditional IT services, and non-core software subscriptions. Models like ChatGPT and Anthropic are actively taking over some of that baseline work. The budget previously earmarked for human services and old software is being directly absorbed by the AI department. When a crucial company drops 12% and the market shrugs, it sends a clear signal. The AI industry is an entrenched, revenue-generating reality, and it is positioned to aggressively consume the rest of the corporate budget.